The Gartland Group presents Taxes, the IRS, and You with your host, Bernie Gartland. Taxes, the IRS, and You is a different kind of show that'll help you solve your tax problems. As former Deputy Attorney General of the state of Delaware and with over 25 years of experience as sole practitioner in both Delaware and California, the name Bernie Gartland has become synonymous with taxes. And now your host, Bernie Gartland.
Hey everybody, Bernie Gartland. Name of the program is Taxes, the IRS, and You, and we call ourselves a different kind of show. I am your host, Bernie Gartland, and we are the Gartland Group. And the Gartland Group consists of American Tax Centers, and the CEO and CFO of American Tax Centers is sitting here, Brian Bauer, and David Wiesen, a tax attorney with Gartland Law. And we have another company now called Griffin Bookkeeping because we found it was necessary to help all of you people out there that have tax problems, business problems, consumer debt problems. We do bankruptcy, we do tax problem solving, we do bookkeeping, QuickBooks, and we do audits. And Brian is getting inundated with IRS audits right now. And we do past year tax returns, current year tax returns, all under the umbrella of the Gartland Group. And our resident panel, Brian Bauer from American Tax Centers and David Wiesen from Gartland Law is here. What I want to tell you very preliminarily about the Gartland Group is that we call it, unfortunately, I hate the name, but it is. It's a one-stop shop. So when you have your business problems, your lending problems, your consumer problems, your bankruptcy problems, any type of bankruptcy, and also your IRS problems, or you want current tax years, and we, by the way, we do a lot of free consulting. We do not charge for phone calls, etc. We like to be business oriented. Now, today's topic is going to be a very interesting topic that we have found that most real estate people, CPAs, attorneys, and everybody else, they just do not understand. Now, we're going to talk about foreclosures and the ramifications. We're going to talk about short sales and the ramifications, deed in lieu of foreclosures and the ramifications. And we're going to hone in on two specific concepts. The first concept is there is something very unique to California, and it's called the anti-deficiency statute. That's easy for you to say. That's all here. Anti-deficiency statute. Dave, you're a lawyer. You're with Gartland Law. What the heck is the anti-deficiency statute in? I mean, if you're deficient, you are anti'd? I don't understand. Tell us what the anti-deficiency statute is as it relates to real estate.
Right, and we're lucky to live in California. It's one of 11 states with an anti-deficiency statute.
Yeah, we don't have any tornadoes and hurricanes, and we're very lucky, right?
Yeah, that's right.
So and our budget's balanced and everything.
And our budget is balanced. And
so, what the anti-deficiency statute it has to do in the loan arena when it's time to get your house foreclosed upon or your property foreclosed.
When it's time. Okay, which is happening every single day here.
Right. So when a property sells at foreclosure for less than the fair market value.
Right. And we're seeing this happen all the time, aren't we?
Right. The anti-deficiency statute talks about whether your lender can sue you. And we're lucky enough in California that if the foreclosed property is a dwelling, owner inhabited, 1 to 4 units, that your lender cannot sue you. And that's what the anti-deficiency statute is. The question is whether you can be sued for the deficiency between the sale price and the fair market value.
So what happens is that somebody bought a house for $650,000, and they now owe.
I'm sorry. Let me clarify. It's not the fair market value and the sales price. It's the amount owed.
Right.
And
somebody bought a house for $650,000. They owe $400,000 on it, and the house is now worth $300,000. So the owner occupier says, "Why am I paying $2,000, $3,000 a month on my mortgage when I'm never going to get that value?" So they let it go to foreclosure. Let's just talk about foreclosure. They let it go to foreclosure. So now they owe $400,000, and the lending institution sells it for $300,000. If you didn't have the anti-deficiency statute, could the lender sue that person for that $100,000?
Absolutely.
Absolutely. That's why you said we're very fortunate to live in California, because the California legislature puts this in to protect people. But it has to be the residence where you live.
Right, and there's another term that's related to the anti-deficiency statute, and that's recourse versus non-recourse.
Okay, explain that.
And recourse is where the lender has the recourse. They can sue the mortgage holder.
Okay.
Whereas non-recourse, which is California, that means there cannot be a suit.
Right.
And when you're negotiating with the lender, you can always try negotiating to have non-recourse be a provision of the loan agreement. Right. And in California, that language always has to be there, whether it's there or not. The Code of Civil Procedure Section 580E, all the 580 section talks about the anti-deficiency statute, but 580E specifically talks about anti-deficiency statute with the lender not being able to sue on a dwelling.
And we're primarily talking about lawsuits for an amount not realized once there's a foreclosure. Now, what about if there's a second trust deed on the house? Does the anti-deficiency statute apply to the second trust deed concept?
Well, actually, if it's purchase money, then they wouldn't be able to sue. And what purchase money means is at the time that you buy a house, say for $500,000. Let's say you got a first for $400 and a second for $100, and you use that to purchase the house. Okay. Then the anti-deficiency statute would apply.
Okay.
Okay. But there's actually a new law it just came in recently on where the second cannot sue in a short sale situation.
Okay. But does that apply in a foreclosure?
The second, if it's not purchase money, let's say subsequent to purchasing the house, you had equity, you took out $100,000 to go on vacation to Europe, they'd be able to sue.
And you know, it's interesting because when the market was such that people were getting into their homes with no money down, okay, and the representatives I don't want to say real estate people, because the representatives were representing them, they would say, don't worry about it, we're going to get a second, so you're going to get in for almost 100%, but it goes to the purchase of the house. That is what you're talking about. That anti-deficiency statute applies to that also. Also, what happens if you refinance and 2 years later, but plow it in to build home improvements or a swimming pool or something to enhance the property? Doesn't it apply there also?
Yeah, I think you have a strong argument that it would. If you can show that you use the money to improve the property.
And what is this new concept for the short sale? This is something that California came up with?
Yeah, something that California came up with, and actually what they're doing is they're amending the language of the 580 section to add any trust deed. It doesn't matter whether it's a first or a second. Okay.
All right. So California is coming right in line with in terms of the second and short sales and everything. And I think what's happening is that over the years, I think all of us in the American Tax Centers as well as Gartland Law has seen there's foreclosures after foreclosures and everything. And what happens is that a lot of people do not want a foreclosure on their record, so they want to get a short sale. And even if they had a short sale, there were certain ramifications that would happen that the second trust deed holder could sue. And now with the new legislation that I think Governor Brown signed into law.
Yeah, I think it was under Schwarzenegger. Oh, the latest one is was with Brown.
Right, and so now it relieves the people of having the worry of lawsuits coming in. So, by the way, now that you all understand everything you need to know about the anti-deficiency statute, and if you don't understand, call Dave. He can be reached at 760-345-1500, and he'll tell you everything you need to know, or email us. Now we're going to talk about, in the next segment, we're going to talk about cancellation of debt and 1099As, which has nothing to do with the anti-deficiency statute. So stick around, folks. We're gonna tell you all about how you are going to pay taxes on cancellation of debt, or maybe not. Hi, folks. I'm Bernie Gartland, and I'm so proud to introduce you to the Gartland Group. Do you have a need to have your current or prior year tax returns prepared? Is the IRS knocking at your door and you need legal representation? Do you need professional bookkeeping services? The Gartland Group can help. Let us put control back in your life and have that control give you a future.
Call today for a free consultation. 760-345-1500.
Hey everybody, Bernie Gartland. Name of the program is Taxes, the IRS and You, and presented by the Gartland Group, which consists of, I'm going to go backwards. I'm going to go from Griffin Bookkeeping to Gartland Law to American Tax Centers. And Brian Bauer, who is an enrolled agent and a former tax auditor for 20 years for the state of California, is actually the head of American Tax Centers. David Wiesen, who is a tax lawyer, and he does criminal work too also for 20 years, is here. And they are both resident members of our panel. We're going to talk to you in this segment about the Mortgage Debt Relief Act of 2007, but I want to impress upon you this, what we're going to talk about now with Brian and Dave, only applies to your principal residence. All the rules and the regulations are different if you have an investment property or a rental property. So the third segment of this program today, we're going to devote to that aspect. So make sure you understand, folks, there's a difference between all these acts, all these forgivenesses concerning primary residences versus rental or investment properties. So stick around for the third segment, which will come up eventually. So, Dave, you did a great job on the anti-deficiency statute, and everybody knows everything about it now.
Everything, yes.
Everything they know. Now, but what about this thing called the Mortgage Debt Relief Act of 2007? What the heck is that?
Yeah, we call it the Bush Bill when we're talking about with clients here, and it's effective until January 1, 2013. Basically, when there's forgiveness of mortgage debt on a principal residence,
okay,
that's a kind of cancellation of debt. And under the Mortgage Forgiveness Act, which has also been enacted in California, and similarly is going to expire at the end of 2012, it's not a taxable gain when there's forgiveness of debt on your principal residence.
Okay, let's go into the scenario that I used before for the anti-deficiency statute. The same scenario, but remember, folks, there's a difference between the anti-deficiency statute and forgiveness of debt. They're apples and Volkswagens. Okay, so the guy bought the house for $650,000, owes $400,000 on it. They get foreclosed on, and the lender sells it for $300,000. So there is in prior years, the anti-deficiency statute would kick in that the lender couldn't sue, but they could issue a 1099-C cancellation of debt because you did not pay back the total $400,000, right, Brian?
Right.
So it's $100,000. So under that old law,
it would be considered income.
It would be considered income, and we're going to explain why. Because they say, "Well, wait a minute,
I didn't get nothing.
I didn't get anything. You took my house." You know. All right. So anyway, what happened with this Bush bill is that it said, "Hold off." Okay, California, you're great. You got an anti-deficiency statute. They can't sue you. Now they cannot issue that 1099-C cancellation of debt. So on the principal residence, what can they do with the first and second on the issuance of 1099-As or 1099-C? Why don't you explain to the folks the difference between a 1099-A and a 1099-C?
Right. You usually get a 1099-A when you have a foreclosure or you abandon the property, basically say, just take it, here's the keys, I don't care anymore.
Okay.
You do a short sale or you do the deed in lieu of foreclosure.
Right.
And a lot of people think, oh, well, they foreclosed on my house, I'm done with it, I don't have any tax consequences. Well, what happens is they issue a 1099-A and it has to be handled on the tax return as a sale. It's treated just like a sale. Here's what the property was sold for. The sales price is on the 1099-A as the full balance of the loan. That's the sales price because that's what you realized.
Right.
Because they're done with it. You don't have to pay anymore. And then they put what was owed, and there's a difference there. If it's your primary resident, it's not a problem because it's forgiven because of this this act in 2007, and they can't come after you. So it kind of washes. But a lot of people get in trouble because they get their house foreclosed on, they move. 8 months later, they issue a 1099-A, and they've moved. They never receive it. They don't stick it on their tax return. And the IRS goes, hey, you sold your house for $600,000. Well, no, I didn't. I got foreclosed on. Well, if you don't put it on your tax return and it's not handled correctly, as far as the IRS is concerned, you had a sale of $600,000, even though you really had a foreclosure. They don't know the difference. You have to tell them that.
And it's very interesting because the concept is hard to understand. Is that what is a 1099-A is considered a sale,
right?
A 1099-C is considered cancellation of debt,
right?
So if it's cancellation of debt, you treat it one way. And if it's a 1099-A, you treat it a different way.
Right. And the 1099-C is actually easier to take care of because it's not treated as a sale. You have to show it on the tax return, and there's 2 boxes that you check. Is this a principal residence? Yes.
Okay.
Have they lived in it 2 out of the last 5 years?
Yeah.
Yes. Then you can exclude up to $5 million of excluded debt. If you're married filing jointly, and 250 married filing single.
500,000.
500,000.
Yeah. So it's very interesting because there is the combination of the anti-deficiency statute and the combination of the Bush bill with the tag-along and the new laws with the short sales, not issuing certain 1099-Cs or if you issue 1099-As, there is a way to handle it for your principal residence.
Right.
Okay.
What we find all the time is that there are real estate people that might understand one part of it.
Right.
There are tax people that might understand one part of it.
Right.
There are bankruptcy attorneys that might understand one part of it, but they don't understand the entirety of it. And I can't even tell you. I would say we probably get a few calls on this every single week. At least a few calls on this every single week that I deal with. I don't know how many between you guys that you deal with.
We get calls at least 1 or 2 a week, and sometimes the banks mess up and they issue you an A and a C.
Right. And what's very interesting, there's a concept you just triggered my mind on something that we didn't plan on discussing today, but it's very, very important, is that the bankruptcy attorneys need to know certain things. Remember, most bankruptcy attorneys don't even know that taxes can be discharged in bankruptcy. And they have to understand the rules of dischargeability of taxes in bankruptcy to understand how the bankruptcy can prevent the issuance of a 1099-A or a 1099-C. And it has to be done at a precise time. Example, if a house gets foreclosed on, and if it would apply that you got a 1099-C, if a house got foreclosed on and 7 months later or 10 months later you file a bankruptcy, that cancellation of debt is still alive and viable. But if you file a bankruptcy that causes the cancellation of debt, then they cannot issue the 1099-C or 1099-A. And it's important, although this is kind of a segue, it's important that the folks out there understand that's what this Gartland group is all about. We have all these areas in here that we understand, every single thing about cancellation of debt, bankruptcy, tax bankruptcy, and so forth, because I see so many people come in that say, well, my real estate person told me that, just let it go to foreclosure. You can always file bankruptcy later. Well, but it's the time of the cancellation of debt. And the problem is people don't understand why they get a 1099-C. And the way I explain it is, I loan you $40,000. You're paying me back. You owe me $36,000. But you used that $40,000 to do something. I win $127 million. I say to the client, yeah, right, and then we're all on vacation. And I say to the client, okay, now I like you. Don't pay me the $36,000 back. You have to declare that as income because you had use of the $36,000. The same thing with mortgage and everything. Right?
And you, the person who loaned the money, have to issue the 1099-C because the amount in question is over $600.
Exactly.
There's ramifications if you were to
Folks,
issue
when
that.
we come back, we're going to talk about investment properties and
credit
cards, and we're going to talk about rental units. All the rules are different than we just outlined. So stay tuned. We're going to give you some very, very important information. All right. Hi, everybody. I'm Bernie Gartland of the Gartland Group. I want to introduce you to the CEO of Griffin Bookkeeping, Kathy Satter.
Thank you, Bernie. Are you a small business owner wanting to increase your cash flow? Or would you like to get your books, your personal or your business accounts organized? We can help you. Griffin Bookkeeping has helped many businesses, large and small, organize their books and quite simply made their lives better.
Let us put control back in your life and have that control give you a future. Hey everybody, Bernie Gartland, name of the program is Taxes, the IRS and You, and we are here every Wednesday, and we call ourselves a different kind of show because each week you're going to be presented with astounding information by resident experts. You guys are now resident experts, by the way. I said panel before, but now you're experts. Okay. We've been talking a lot about cancellation of debt, 1099-C, 1099-A, anti-deficiency statutes, and so forth. I hope you're TiVoing all this because all this information you need to play back until you get it because there's so much information.
Well, they can just call us.
They can call us, right? You know what I tell people because we go through so much when we do strategizing because of the different groups we have here. Say it's not important that you understand everything that I'm saying. It's important that you understand that I understand what I'm saying. Okay, so David Wiesen, who's a tax attorney, outlined to you with legal jargon all the anti-deficiency statutes and the Bush bill, and we talked about all the laws involved. Now we're going to segue over to the CFO and principal owner in American Tax Centers. Brian Bauer was a tax auditor for the state of California for 20 years. He's an enrolled agent. That means he can practice in front of all the taxing authorities and represent you, especially in audits. We're getting a lot of audits in here. But Brian has really honed in on what is the tax consequences of a 1099-C and a 1099-A. Now, the last segment we talked about it as it applies to principal residents. Now we're going to talk about how it applies elsewhere. And I'll give you an example. I had a gentleman, a young fellow, came in to see me a couple of years ago, and he was all perplexed because he got a 1099-C for $21,000. And I'm looking at it, and I say, okay, so the Citigroup issued a 1099-C for cancellation of debt. He says, yeah, but I settled with them. I said, well, what do you mean you settled with them? He said, well, I owed them $26,000. I made an agreement with them that they wouldn't sue me if I gave them $5,000. I gave them $5,000 and settled it. Now I got this thing called a 1099-C. IRS says now I owe money on this.
Right. Like, what the heck is this?
What is this? It's cancellation of debt. The credit card people are very, very tricky. And they'll say, we'll settle this debt. We won't sue you.
They don't tell you about the 1099-C that's coming.
They don't.
Yeah.
They don't. So that is a cancellation of debt for credit cards. We're seeing it all the time now.
We're seeing it more.
How does that apply to investment or rental units and everything as you see them coming in?
Well,
because it's the same difference,
yeah,
isn't it?
You can get a 1099-C on your principal residence, and usually we can exclude that. If you get a 1099-C on a credit card, and we're seeing lots of those, Visa, MasterCard, American Express, that's income to you. There's no forgiveness of that unless you qualify under certain circumstances for other things, or we're gonna talk about those remedies. But if you get a 1099-C on forgiveness of debt on a credit card, that amount that's on there is income to you. And it's just like the example you said with you loaned Dave $40,000. Basically, the credit card company loaned that guy $26,000, and he went out and bought stuff, and he only paid $5,000. So the other $21,000 is income to you.
Right, and that's why the 1099-C cancellation of debt. And by the way, the client gets a copy of that, and the IRS gets a copy of that.
And if you don't include it on your return, they let you know.
Hello.
Yeah, and
you get that letter.
Exactly.
Yeah.
And then the 1099-A, you can get issued a 1099-A if a rental property is foreclosed on.
Right.
Well, the Mortgage Act of 2007 doesn't apply to a rental property. You only get to exclude that forgiveness of debt on your principal residence.
Exactly.
So that, in turn, also can become income to you.
And is there a way to... Well, the 1099-A, by the way, when you get foreclosed on, especially for a rental unit or investment property, is considered a sale.
It's considered a sale.
And and again, remember we were talking about that the people couldn't get the concept of, wait, I didn't have any use of that money, and then you explain you had the use of that money. The same thing with saying, I didn't sell the property. I got foreclosed on.
Right.
I gave a deed in lieu of foreclosure, and how can they call it a sale? It's a sale.
Right. But there is good news because if it's not your principal residence or you got this forgiveness of debt on a credit card, there's a section of the law for the IRS, Section 108, which says you don't even have to include it on the tax return. There's a form we have to fill out, a 982, that shows what we're excluding and why. But Basically, in layman's terms, it says if you're insolvent at the time that the debt was forgiven, you don't have to include it. And what's the definition of insolvents, Bernie?
It is your liabilities exceed your assets.
Right.
All right. And what happens is this, and the folks don't realize this, there are remedies. It's Section 108 of the Internal Revenue Code. It's not a policy. It is a section of the code. It's a law. And what it says is that if you are insolvent at the time of the cancellation of debt, it does not have to be taxable. However, you can't, and I see this all the time, Brian, and you see this. People go to tax preparers, not our firm. They go to other tax preparers and they say, oh, you were insolvent, so don't even include it on your income. Remember something. The IRS has the form.
You have to explain why you didn't include it on.
Exactly.
So you have to fill out the 982 and say why you're excluding it.
Let's go into that. There's a special form that the IRS provides.
And they're looking for it.
And they're looking for it. It's called a 982.
Right.
So what happens is that if your liabilities exceed your assets, you're insolvent. But you know what? We have some people that aren't insolvent.
Right.
So they have to pay the tax on it.
On that. They do.
And you know, the interesting thing is, isn't a 1099-A on rental or investment property treated differently than the 1099-C? How do you treat it differently on a tax return?
Well, an A, it's like we said before on your primary residence, it's a sale. It goes on what's called a Schedule D. It's a sale. It's like listed like you sold a stock.
Right.
Here's your cost. Here's what you sold it for. Here's when you bought it. Here's when you sold it. It's treated as a sale. A 1099-C, you just say, forgiven debt, Visa, MasterCard, American Express, and it goes right on the front of your tax return as income.
I've coined an expression when I was doing my radio show for many years, and I have to watch myself when I'm out in rubbing elbows with the blue blood, so to speak. I don't blue bloods. I always say we like to educate people. Okay, and that's what we're doing here. We're educating you. The interesting thing is, you really want that 1099-A rather than a 1099-C.
An A is easier to get rid of than a C.
Especially if it's for an investment property or so forth.
Absolutely.
Because can you take a loss?
Yeah, you can. You don't get to recognize the loss, but if you show a loss on the sale of a rental property, there's no tax consequences.
Exactly.
There's no additional income there.
But there could be tax consequences for a 1099-C.
Absolutely.
Right. So, I mean, we're talking about who's on first, what's on second, I don't know who's on third. And what we're talking about is exactly what we get involved in on a day-to-day basis.
Right.
This stuff is complicated. So wait a minute. If I have my primary, they can't do that. And then the anti-deficiency statute, which has nothing to do with the Bush bill and nothing to do with California, but I can't sue me. But they can do a 1099-C, and they can do this. No, if I have an investment property, so they may issue a 1099-C, they may issue a 1099-A, but
they may issue both.
Or they both, and A is better because it's a Schedule D. Folks,
just call us.
Just call us. You know who we are. We've been around a long time. The Gartland Group is here for you. American Tax Centers, Gartland Law, and our new company for your bookkeeping and QuickBooks needs is called Griffin Bookkeeping. And you're going to see a lot about us. You're going to see our logos. You're going to see television commercials because we know what we're doing, and it's a one-stop shop. So with that, we will see you next time. And this program, Taxes, the IRS, and You, is presented by the Gartland Group. And David Wiesen from Gartland Law, say good night.
Goodbye, everybody.
All right. And Brian?
Good afternoon.
Good afternoon. And it is the afternoon. Good night, everybody.